This is the first video on our extended series on the taxation of estates, gifts, and trusts. The basics of gift taxes. Let's talk about the gift tax first. The gift tax may apply to the transfer of property by one individual to another, whether the donor intends the transfer to be a gift or not. Gift tax is imposed on the donor, not the receiver of the property. So the gift tax is not an income tax. The gift tax is a tax on the transfer of property, and it is intrinsically linked to the estate tax. What this means is that basically the US government or Congress, because Congress is the one that decides tax law. Congress doesn't want wealthy people to give everything that they own away without having to pay some tax on that transfer. So the gift tax and the estate tax are not income taxes. They're a tax on the transfer of property to another person. The gift tax and the estate tax generally only affect very wealthy people, but it's a tax on the transfer of property. You're not allowed to give an unlimited amount of property to like your heirs or your children or, people that you like, whatever, okay? The gift tax and the estate tax are designed to prevent like an unlimited transfer to your heirs, okay? And I'm going to explain this as I go along. I know that maybe these concepts are a little bit confusing, but just listen to me. Just listen to me talk, and I think it's all going to become clear as we go along. Gift tax is imposed on the donor, not the receiver of the property. So if I give a gift to like my cousin, and it's above the reporting requirement, above the reporting thresholds, then I might have to file a gift tax return. My cousin, the person who receives the gift, isn't going to file anything. It's going to be me, if anybody's going to be doing any of the filing. Now, the only exception to that rule is if you have a gift that's coming from either a foreign donor or a foreign estate. So in that case, sometimes the donee, the person who's receiving that gift, will have a filing requirement, but that's related to foreign reporting requirements. It's not part of this gift tax thing. Just realize that if you have someone who's receiving a gift or a bequest, if they're receiving something from either a foreign donor or a foreign estate, then all bets are off. Then you might have a reporting requirement as the donee, the person who's receiving the gift. But if it's someone who's a US person that's giving you a gift, then any reporting that has to be done or gift tax that has to be paid, that's always going to be done by the donor. That's the person who's giving the gift, not the person who receives the gift. Gift taxes are reported on Form 709, United States Gift and Generation Skipping Transfer Tax Return. I think you need to know this form number for the test. So Form 709 is for gifts, and Form 706 is the estate tax return. It's only different by one digit. So 709 is gifts, 706 is estates. And the way that I always tell candidates to remember, exam candidates, I always tell you to remember the difference between those numbers is that the 706 is for estates, and that's when somebody is 6 feet under. 706 estates, 6 feet under. That's a dead person. They're 6 feet under the dirt. Okay, so 706 is for estates, 709 is for gifts. Form 709 is the gift tax return. A Form 709 must be filed if a taxpayer gives more than the annual exclusion amount to at least one individual, except to a U.S. citizen spouse. So U.S. citizen spouses can gift things back and forth to each other, and there's no limit. Like I could give my husband $1 million in cash. My husband could give me, a $10 million necklace, assuming that we had that kind of money. And there would be no reporting in that case. If both of the spouses are U.S. citizens, then there's no reporting. You can gift anything you want back and forth. But if you give something to another person and it's more than $15,000 in a single year, then you might have to file a gift tax return. Not always, but $15,000 is the annual exclusion amount for gifts in 2021. The annual exclusion amount for gifts is going to be $16,000 in 2022. So it's going to go up, and it's been $15,000 for several years, but this is going to change in 2022 and it's going to go up. But just realize if a taxpayer splits gifts with a spouse, they might have to file a Form 709. And I'm going to give you an example of what a split gift is. You also need to know this for the test because the IRS has tested on split gifts in prior exams. If the taxpayer gives a gift of a future interest to anyone other than a U.S. citizen spouse. And I'm going to explain what a future interest is as well. Form 709 is the gift tax return. It's generally due by April 15th of the following year. So it has the same filing deadline as an individual tax return, but it's a separate tax return. It has its own signature line and the whole 9 yards. So Form 709, the gift tax return, is a separate filing altogether. If a taxpayer extends their own tax return with a Form 4868, then the gift tax return is deemed to have been automatically extended as well. So this is a little bit weird here. So if you have a Form 1040 filer, an individual taxpayer, and they extend their Form 1040 for 6 months using the Form 4868, then they are deemed to also have extended their gift tax return, assuming that no gift tax is due with the extension. However, if a taxpayer does not extend their individual return, or for example, if they don't have a filing requirement at all for their individual tax filings, like if the person doesn't have to file a Form 1040, but for some reason they have to file a Form 709, and you have a reportable gift, then there's actually a separate extension form for the Form 709, and it's Form 8892, application for automatic extension of time to file the Form 709. So if a taxpayer actually has to file a Form 709, but they need extra time, and they extend their own tax return with a Form 4868, then they're deemed to have also extended their Form 709. But if they do not file a Form 4868, then they're not deemed to have extended their gift tax return, and they can use a separate extension form, the 8892, in order to extend just the gift tax return if that's the only thing that they need to file. I've personally never used this form, the Form 8892, because usually people who are wealthy enough to be giving very expensive gifts or to be giving out more than $15,000 in cash to family and friends or relatives or whatever in a single year, they generally have a filing requirement. They generally have to file a Form 1040. But for some reason, if you have a person who doesn't have a filing requirement and doesn't have to file a Form 1040, or if they've already filed their Form 1040 and they didn't file the Form 709, but they have to file the Form 709, but they need extra time, then they can file an extension. So there's a separate extension for this form, the Form 8892. But if you file the Form 4868, you don't need to use this extension form. Yeah, I know it's overly confusing, but this is how it is. Okay, let's talk about future interests because I want you to understand this legal concept. A future interest is where you're giving something to someone, but they don't get to use it right now, or they don't get to own it right now, but they will get to own it or use it in the future. In the future. This is something that like wealthy people do, or that taxpayers do when they want to like gift their home to their kids, but they still want to live in it right now. Like, you can have my house, but not until after I'm dead. All right. That's a future interest. So a gift is considered a present interest if the donee has all immediate rights to the use, possession, and enjoyment of the property or income from the property with no strings attached. So if I just give a plot of land to a family member, like I'm going to give a plot of land to my brother, and I say, here, you can have it, and it's all yours. Then he has the right to sell it, use it, live on it, build a house on it, whatever he wants. That's a present interest. That's no strings attached. I give him the gift, and then it's his. He can do whatever he wants with it. But if there's strings attached, like, I'm going to give you this land, but I'm not going to let you sell it. I'm only going to let you use it. You can have it maybe after I'm dead. That's an example of a future interest. That's when the donee That's the person who's receiving the gift. The donee's rights to the use, possession, and enjoyment of the property or income from the property will not begin until some future date. This is a strings attached gift. A gift of a future interest cannot be excluded under the annual exclusion. With a future interest, the beneficiary typically does not become the owner of the property until the donor's death. So the IRS doesn't want you to be doing anything sneaky like this in order to get around the estate tax, where you are giving someone something, but you're not really giving it to them until after you die. They don't want you to do this little sneaky stuff to get around the estate tax. Let me give you an example. Shepard creates an irrevocable trust for the beneficial enjoyment of Bethany, who is his girlfriend. So they're not married, so it wouldn't be able to be excluded under the unlimited marital transfer. Like you can just transfer assets between a spouse back and forth. If both of them are US citizens, you can give each other assets back and forth, anything, cash, property, land, and it doesn't matter. And that includes a future interest. So I could potentially tell my husband, I'll give you this land, but not until after I'm dead. And it's a future interest, and it's fine because he's my spouse. So gifts of a future interest to a spouse, they don't have to be reported, assuming that both of the spouses are US citizens. But in this case, Shepard is going to give a future interest to Bethany, but she's just his girlfriend. They're not married. Shepard transfers an office building to the trust. So he creates a trust and he transfers an office building to the trust. The office building is currently rented to business tenants and is subject to a mortgage. The terms of the trust provides that the rental income from the property will first be used to pay off the mortgage. After the mortgage is paid in full, the net rental income will then be paid to Bethany. Since Bethany's right to receive the rental income will not begin until after the mortgage is paid in full, the transfer in trust represents a gift of a future interest. So he's giving her something, but not until a future date. She's not actually going to get money from this trust, which is holding this office building, until the mortgage is paid off. So she will presumably be getting money, but not until sometime in the future. So this is an example of a future interest. He's giving her something, but not until later. Gift splitting. The basic exclusion amount and the annual exclusion amount apply separately to each spouse, and each spouse must separately file a gift tax return if he or she made reportable gifts during the year. So I would be able to give up to the annual gift exclusion amount, the annual limit, and then my husband would also be able to give up to the annual limit. That's perfectly fine. It applies separately to each spouse. However, if either spouse makes a gift to another person, the gift can be considered as being one half from one spouse and one half from the other spouse. This concept is known as gift splitting. Gift splitting allows a married couple to give up to $30,000 in 2021 to a single individual without making a taxable gift. They still need to report it, but it's not a taxable gift. Both spouses must consent to split the gift, though, if they're going to do this. So both spouses have to agree. Let me give you some examples. Moises and his wife, Alinda, agree to split gifts of cash. So they're just giving one person cash. Moises gives his friend Jose a check for $21,000, and Alinda gives her niece a check for $18,000. Although each gift is more than the annual exclusion amount, they can use gift splitting to avoid making a taxable gift to each donee. In each case, because one half of the split gift is not more than the annual exclusion amount, it is not a taxable gift. And I want you to understand that most of the time when people give gifts to other people, that's not a taxable event. But if it's over the annual exclusion amount, that what ends up happening is it counts against that person's eventual estate tax exclusion. It will whittle away the amounts that they are allowed to basically bequeath or give or transfer to their heirs after their death. That's why the gift tax and the estate tax are intrinsically linked. But if you have a person who gives less than $15,000 a year to a single person, then not only does that not have to be reported, but it also doesn't count against their estate tax exclusion later on after they die. Now, I'm going to explain this more as I go along. Just listen to me. Just listen to me. If you have a person, a single individual, that gives more than 15,000 to another individual in a single year, whether it's cash or property, then that's a reportable gift. But you can have spouses where they can agree to give more than the gift limit, but if it's less than $30,000, then it doesn't count against their estate tax exclusion later. Okay, they still have to report it. So if you gift split with a spouse, then you still have to file a Form 709, but it's not a taxable gift. However, a gift tax return is required. See, because Moises gave 21,000 to a friend, and then Alinda gave 18,000 to her niece. They just wrote one check. If they had written two separate checks, then they wouldn't have had to file a gift tax return. But they just wrote one check each, and both of these checks were over $15,000. So now they have to file a Form 709. They have a reporting requirement. Gertrude gives her favorite cousin Freddie $25,000 with a single check. Gertrude elects to split the gift with her husband Maurizio, and Maurizio is treated as if he gave Freddie half the amount, or $12,500. Assuming they make no other gifts to Freddie during the year, the entire $25,000 gift is tax-free. And Freddie doesn't have to report this anywhere on his tax return. A gift is not income to the recipient. Okay? However, a gift tax return is required in order to report the split gift. And they could have avoided filing a gift tax return simply by writing two separate checks. But they didn't do that. So now they have to file a Form 709. Now here's an example of a Form 709. This is a United States gift and generation skipping transfer tax return. This is just a sample from the IRS website. This is not a real person. This is the person who's giving the gift. This is the donor, the person who's giving the gift, not the person who's receiving the gift. The donor is the one that has to file the gift tax return. And this is an example of gift splitting. When you split a gift, the consenting spouse has to sign. So Jordan is married, and this is his spouse, Billy. She has to put in her social security number, and she also has to sign the gift tax return. If it's a split gift, she has to consent. If she doesn't consent, then you can't treat it as a split gift. And as you can see down here, there's a separate signature line, and there's a place to put the preparer's signature and the preparer's information. So this is considered a separate tax filing. It doesn't go along with the Form 1040. You don't attach it to the Form 1040 or anything like that. Potentially, you could have a person that doesn't have a filing requirement, but still has to file a gift tax return. Sometimes that will happen when people are older and they're just on Social Security, but they have a lot of money saved. Like, let's say they have a lot of savings in the bank and they start giving gifts away that are over the gift limit to their grandchildren. And sometimes that'll trigger a Form 709 filing requirement because they're giving over the gift limit, but they don't have a filing requirement, but now they have to file a gift tax return. So sometimes that will actually happen. Gift splitting in community property. A married couple can avoid filing a gift tax return if they make each gift separately, such as by writing separate checks or giving separate property. In the previous examples, if each spouse had written separate checks for less than the annual gift limit, then a gift tax return would not be required. If married couples split a gift, each spouse must generally file his or her own individual gift tax return. However, certain exceptions may apply that allow for only one spouse to file a return if the other spouse signifies consent on the donor spouse's Form 709. If gifts are made by a spouse from community property funds, the gift is deemed to have been made 50% by each spouse. So in a community property state, the IRS deems the gift to have been made 50% by each spouse, or if it's made from community funds. And I want you to understand this. A lot of wealthy people, when they want to give gifts to family members and have the gift be under the gift limit, what they will do is they will do this type of tax planning. Well, they will just give separate gifts to multiple family members. which is perfectly legal and not shady or underhanded or anything like that at all. For example, like if I won the lottery and I had millions of dollars and I wanted to give money to my family members, let's say I wanted to give money to my brother. My brother is married and he has 2 kids. I could give 15,000 to my brother, 15,000 to his wife, and 15,000 to each of his kids in separate checks. A child is an individual, right? A child is a human. And it doesn't matter if that child is an infant. Like a 9-month-old could potentially have a bank account, right? Parents will sometimes set up bank accounts for children and they will save money in there, right? So children can have bank accounts. So that's a way to avoid having to file a gift tax return, is you can give individual gifts to multiple family members, and as long as each gift is under the annual gift limit, then you won't have to file a gift tax return. So I could give 15,000 to my brother, 15,000 to his wife, and 15,000 to each of his kids, and I wouldn't have to report anything, and that's a non-taxable gift. So I wouldn't have to file a gift tax return for any of those. So that's a type of tax planning that wealthy people do. It's just that once you give a gift that goes over $15,000, then that's when the reporting requirements kick in. Now, some gifts, regardless of whether or not they're above that $15,000 limit, do not have to be reported. And we're going to talk about those next. Non-reportable gifts. Now, you need to know this for the test. Which gifts don't have to be reported? An individual taxpayer's liability for estate tax and gift tax is subject to a combined basic exclusion amount, and the use of any portion of this exclusion amount to reduce payment of gift taxes during the taxpayer's lifetime will reduce the amount available upon death to reduce applicable estate taxes. There's a limit to how much you can give away to other people during your lifetime or pass to your heirs after your death. There's a limit to that. And then if you go over that limit, then you're going to be subject to the estate tax or the gift tax if you're giving away gifts that are over the gift limit while you're alive. However, if the amounts are under the annual exclusion, right, for gifts, that $15,000, that doesn't have to be reported, and that doesn't count against the exclusion amount, the basic exclusion amount. So you could give $15,000 to all of your family and friends every single year, and you never have to report it. That's not a taxable gift, and it won't count against your basic exclusion amount for your estate when you die. Now, there are some gifts that it doesn't matter how much they are, then you don't have to report on Form 709. And these types of gifts also don't count against your estate exclusion amount, your basic exclusion amount, which is the maximum that you can pass to your heirs or your relatives after your death without the estate tax kicking in. Okay? And if you still don't understand what I'm talking about, just keep listening to me. It's all going to come clear. We have a lot of slides to go through, and I promise you're going to understand this by the end. So if you give a gift to an individual that does not exceed the annual exclusion amount, in 2021, this is $15,000. Any gift that's less than $15,000, let's say you give cash to somebody, you don't have to report that anywhere. You don't have to file a Form 709. If it's tuition or medical expenses paid directly to the educational or medical institution for someone else, it doesn't have to be a family member. It can be a friend, it can be a girlfriend, it can be a relative. It doesn't matter. If you pay someone's tuition or if you pay their medical expenses, but you make the check out or you do a credit card payment or whatever, however you want to pay, if you actually pay it directly to the educational institution, the college, whatever, or medical institution like the hospital, if you're paying medical expenses, and the recipient of that gift never actually has constructive receipt, you just make the payment directly to the institution, then it doesn't matter how much it is. That also doesn't have to be reported. There's no gift tax return requirement in this case either. And it doesn't have to be a relative, doesn't have to be a dependent, none of that. It can just be a friend. Okay? Unlimited gifts to a spouse, as long as the spouse is a U.S. citizen. Gifts to a political organization for its own use. So gifts to a political organization are not deductible anywhere. and they're also not considered a charitable gift. But gifts to a political organization don't ever have to be reported. Isn't that convenient? So if I had $100 million in the bank and I wanted to give $1 million or $10 million to the Democratic Party or to the Republican Party or to the Green Party or whatever other party I wanted to give it to, I wouldn't have to report that anywhere. So no gift tax return would have to be reported for that gift. Any gifts to a qualifying charity. So if I give a gift to a 501c3 charity or any other charity, then I don't have to report that either on Form 709. And then a parent's support for a minor child. This may include support required as part of a legal obligation, such as by a divorce decree. So there are some times where wealthy people have, legal obligations for child support, and they have to pay, if it's like some superstar or some sports celebrity or something, they have to pay more in child support per year than the annual gift limit. But that's not considered a reportable gift. The funny thing is that many times when you have a divorce decree, the payments for child support will go on past the age of majority, like after the child is 18, as long as the child is still in school. There's some 18-year-olds that are still in high school, right? Everybody understands that. But the code actually just says a parent's support for a minor child. It's kind of silent on what you're supposed to do once the child becomes a legal adult. And I wonder about that sometimes, but I think the IRS has kept this nebulous on purpose, actually. So a parent's support for a minor child, that's also not considered a reportable gift. Whether it's required as part of a legal obligation, like by a divorce decree if it's mandated, or even if you're just supporting your own child, and it's not part of a divorce decree, a parent's support for a minor child doesn't have to be reported on the Form 709. But like I said, the code doesn't give us any guidance on what you have to do once the child turns 18. The gift tax examples. Example number 1. Mac is 26 and Lynette is his mother. Mac is not claimed as a dependent on Lynette's tax return. He files his own return. But his mother, Lynette, still likes to help her son financially. So he's 26. So he's not a qualifying child anymore, and he's not claimed as a dependent. But Lynette is his mother, and she still wants to support him. So Lynette gives her son, Mac, a gift of $15,000 of cash during the year. She also pays his college tuition, totaling $21,000, and writes a check directly to the college. Lynette also pays for Mac's medical bills by issuing an $18,000 check directly to his doctor's office. None of these gifts are taxable, and no gift tax return is required. Example number 2. Andrew is single. Andrew gives his nephew Jimmy $39,000 to help start his first business. The money is intended as a gift, not a loan, so Andrew is required to file a gift tax return, Form 709, since the amount exceeds the annual exclusion amount. And, he could have probably gotten around this, having to file a gift tax return, if he had given Andrew $15,000 just as a gift, and then written up loan documents for the remainder, and then he could have forgiven that loan over time. So there's a ways around this legally, the gift tax return reporting requirement. But what ends up happening in real life is many times these taxpayers will come into you and they've already given the gift. And then you have to deal with the reporting requirement afterwards, after they've already done it. So tax planning, in order to avoid a gift tax return, has to happen beforehand, before they actually do it. And many times taxpayers will have already done it. And they come into you and then you realize that they have to file a Form 709 because they've already given the gift. If they had come and asked you advice beforehand, then there probably would have been ways to get around it. But most of the time when they come into you, they've already done it. They've already completed the gift. And so you're stuck having to file a Form 709 after the fact. This is an extended series continued in the next video. Make sure to subscribe to our channel to get notifications for our tax law updates.